I started my investing career long time ago, 1981. So it's 40 years, 40 years ago. So I started closer to the way Benjamin Graham would do. At that time in 1981, there were a lot of nets. The market had gone nowhere for close to 18 years or so. Like it was around the Dow was around 1,000. And in 1981 was below 1,000. It was around 600, 700. So there were a lot of bargains. The Dow was roughly around 6 or 7 times earnings. You'll never see that again. And also there were lots of net working capital, the way Benjamin Graham had made it famous. So I started from that way of investing, which was the safest way to do it if you don't have enough business experience. And so Buffett played a big role because he taught us that it's important to understand companies, how they are run, to understand management. And so gradually I went towards that route as I became more experienced in knowing how companies are run. So I was part of Fairfax. Fairfax started in 1985. We bought a small company, and I worked there for a while. And that's where I got my operating experience. So I have a style where I could go anywhere. I could go with some really mediocre companies to some really great companies. So I've invested everywhere. And so 3 years ago, I did buy an insurance company, and that has done really well. The portfolio has done really well. So the book value has grown has $70 million in 1918, and right now is about $126 million. So you can see the way what Buffett has done. You can copycat in a way, and has worked out really well for me. So that's basically my career. And if you have any questions, please feel free to ask.
So you also what makes a difference for you, I guess, is that you're also investing in debt, right? In debt.
Yes.
Bad companies.
So I also have gone into that. I'm comfortable with buying companies that are distressed or troubled, and that has worked out really well because when I bought this insurance company, Stone Trust, as you know, you have to invest a fair amount of it in fixed income securities and also in equities. So you go with that are AAA to somewhere where it's unrated. So I've gone all over the place, and that has worked out really well. That was another area where it give you a big boost. Now a lot of insurance companies have a big disadvantage because they don't know how to invest outside of AAA. So if you AAA, let's say companies and AAA bonds. So if you buy those, you're getting less than 1% return. With almost zero interest everywhere. And we are able to get more than 6-7% on our portfolio, which makes a huge difference on return on equity. Now, with Stone Trust, the insurance company that I bought, if I went a typical way, let's say typical insurance way, and put all the investable assets into fixed income of, let's say AAA bonds, the return would be like $75 million. Would just go up to most probably, let's say, $75 million instead of being $126 million. The operation can only do so much, but if you don't know what to do with the float, that's what we call all the investable assets, the return will be kind of mediocre. So for us, if you're good at investments, we can use that investable assets that insurance company has and invest it, and then the returns become fairly decent. I can go fixed income, I can go equities, I could go preferred, and I can even go sometimes like derivatives. So it's a broad-based experience that's worked out really well.
How did you find these companies, the insurance companies in the US? I guess did you search for look at some metrics, or someone told you about these companies? Were they available to be sold? How did you find them?
Yeah, this one was lucky. The first one I bought was Stone Trust. My friend Monish Babrai bought it initially in 1914 or 1915, and he wanted to sell. And he gave word out in 2017 that he wanted to sell, and I was able to contact him. And then we made a deal within 5 minutes, at least the gist of the deal. and he agreed to sell it to me around book value with certain conditions, let's say on the reserves, how the reserves will work out, and that has worked out really well. Because I'm in the insurance field now, the first one is always difficult, and because I'm in the insurance field right now, so I do get a lot of calls, like at least 2-3 ideas from investment bankers that have insurance companies for sale, and so it's easier now than before.
And the other one?
Yeah, so I have a few other ones that I'm looking at right now. The problem is all the ones that the investment bankers have brought to my attention, they all have been like deeply troubled companies. On the surface, it looks decent, but you have to be very careful in insurance, because in insurance, the key thing is reserves. Reserves means claims that have not been paid, and how much claims are going to be paid in the future is highly subjective. Like it could go anywhere. Let's say you say $100 is the claim I'm supposed to pay, but it can go anywhere from $100 to $200. And so what we are finding is that reserve is the key. And so a few insurance companies that I've looked at, there was one with a book value of $22 million. But once we checked on the reserves and redid the math on the reserves, the book value was actually only $3 million. So it's not like you buy it at 22 and you want a 10% discount, and therefore you buy it at $20 million, therefore it's cheap. They can really play with the numbers, because everything is based on your assumptions, what assumptions you put into it. So insurance is, unless you're in that field, you can be taken advantage of. You can see, like over the last 40, 50 years, Buffett has made it kind of popular buying insurance companies because of the investable assets. Very few companies have done well. You can see Markel have done well, and Fairfax has done well, and there's maybe 2 or 3 other companies, but most of them, hedge fund managers going into it, have not done well, simply because they don't know, sometimes how to evaluate their reserves, which is extremely tricky, and you do play with numbers.
Pawan?
Yeah. Hi, Mr. Chou. Thank you for your time. I had a question on the Stone Trust. You mentioned, I think, in one of your earlier talks, when you're pricing these insurance business or you're valuing these insurance business, you will buy it at maybe price to book one time, or maybe 10 to 20% at premium. So what are the metrics you look at other than the reserve when using the valuation metric, and what's kind of your margin of safety in that?
Yeah, so reserve is one of the key things, is extremely important that you need to be kind of close. So when I bought Stone Trust, I was unsure of 15% of reserves, where it could be up or down. So the purchase price was roughly book value, but I only had to pay up 85% of book initially. The other 15% was dependent on how reserves would go. And luckily, in this case, the seller was really honorable, and he said he doesn't believe there would be any issues with the reserves. So after 4 years, we found no issues with the reserves. So that is one thing. The second one that I was a little bit concerned about going into this is that whether this company had enough reinsurance. As you know, you shouldn't take all the risk, and you should parcel it out to someone else. You should only take a risk up to a certain amount. And I found that, at least based on my experience, that the reinsurance treaty were not adequate. So the first thing after I bought it, I went to the CEO of Stone Trust, Mike DeLeo, and I said, this is my real concern, is the reinsurance is a little bit on the light side. I need to tighten it up. I'm not comfortable with it. So what he did was to tighten up the reinsurance policy. So in case if we have a really bad time, and there will always be some years where you can be hit. Sometimes we have no control of it, that we are really covered. And so that was one of the first thing he did, or at least I told my CEO to do it. So the reinsurance is really key. You cannot play and take like unnecessary risk. The risk should be all controlled. It's the same thing like in investments. You just can't buy any stock and said it will go up. You always buy it with at least a cushion, a margin of safety. So it's the same idea here.
Okay.
Now, Yeah, so those experiences were born out. Like I was brought up in the 80s, and there was a company called 20th Century, right? Has 20th Century Insurance in the 1980, and so ran beautifully. And it was in auto and homeowners, and the combined ratio was always around 80%. If it is at 100, combined ratio is 100, then it's break even. At 80% means they were really making money, but they were really light on insurance. And what happened one year? An earthquake hit, and that company went bankrupt just because it did not have enough reinsurance. So over the years, all those things, company doing well, and suddenly one year you have an event, a natural event, and they go bankrupt. That's not the way to run an insurance company. So you should always pay up, just like when you buy your car insurance, to have some cushion against adversity.
Yes, you're right.
Well, thank you, Mr. Chou. This is a real treat for all of us to have you here. Two questions related to the Stone Trust. So one, I remember in a talk that you gave with Mr. Pabrai, one of the advantages that you cited about the Stone Trust was that Monish Pabrai had moved it to Nebraska, which allowed you to invest more in equity. So when you are buying some of the others, other or new insurance companies, are you also then moving it to a favorable geography or to Nebraska or under Stone Trust, or how do you go about it? And then the second, go ahead.
Sorry,
I can ask.
Sorry, go ahead.
Oh, no, that's
okay,
fine.
So what you're asking is a really good question. Now, certain states in the United States have different rules, so the commissioner, let's say, of some states would have, let's say, you can only invest 5%. Right, 5% of only 5% in equities, 5% of your capital in equities. Whereas with Nebraska, you can go up as high as let's say 1 times equity. So that makes a huge difference to the returns. So if it is really strict, so we go to Nebraska, and Nebraska became more lenient because they have the Buffett rule. Buffett has done so well in Omaha. In Nebraska, and therefore they're much more favorable to looking at equities as an investment in the insurance portfolio. So definitely, when you buy an insurance company, you cannot go into certain states that are extremely regulated, extremely, let's say, against buying equities. Therefore, the returns won't be there. So what Pabrai did was one of the smartest things. He did the smartest thing by moving it to Nebraska. He took 1 year of hard work, 1 year of frustration, moving it to Nebraska, but that was the right thing to do.
Okay, and then the second question related to that is to Stone Trust was, you had also mentioned that you left the Google holdings because you thought it was at 500. So I'm sure that has done very well. Now that I don't know if you still hold it within Stone Trust, but related to that, coming from a traditional Ben Graham background, I know recently you have been mentioning that it's better to buy, if earnings are growing much faster, then you have another sort of a margin of safety. So can you give some perspective on how you look at investments, or what you look at specifically, like things like Google or similar companies, if you've had any new investments?
Yeah, so you have a really good question, and there has been a traditional over the years now traditionally seesawing between something buying really cheap that you're sure of, and something like buying future earnings that you can see there, but you're still unsure where the earnings would be. But in general, if you're asking me just based on my experience, it's better to go with companies where the intrinsic value is growing. If you buy into a company where the intrinsic value is not growing, even if you buy it cheap, may not work out the way you think. You can just take an example. Let's say something is worth, let's say, $100. You think a fixed asset is worth $100, and right now, if 10 years from now that fixed asset is still worth $100, you haven't made any money, right? Even if you buy it at 50. But if you have something that's at worth let's say $100 today, but every 5 years it doubles, that is a 15% return. So 100 goes to 200. And another 5 years, that 200 goes to 400. So 100 has gone to $400 at a 15% return. So you see, in 10 years, 100 is worth 400. The other one, even if you buy it really cheap at $100, let's say worth something 100, and you buy it at 50, it's still $100 there. The other one has gone, the intrinsic value has gone from $100 to $400. Yeah, but to go and buy into companies that are, good companies, management. My feeling is that you should be involved somewhat in companies, somewhat like have been run companies or been involved in that. Then you can see how the intrinsic value is growing. So if you can be sure of a good company that is growing around 10% a year, it's better to go with a company that you can pay up, let's say 70 to 80% rather than trying to get it at 50 to 60% of the intrinsic value. So Buffett has shown a way, and he has been super accurate, because when Buffett buys into some of these higher quality companies, his assessment is based on how the company will do 10 years from now, and that you can get it only from experience. Whereas when you buy the Benjamin Graham one, is something is worth 100, and you can see it on net working capital. You're buying at 60% of 100, so you're kind of assured of $100, even if it is not growing. But then you have to trade a lot more often. But those are the pros and cons. But over years, I've been more involved in businesses, and so I can see and have a better sense of how to judge management, how to judge the operation, and how to judge the economics of the business. And I'm now, let's say, much more confident buying into better quality companies.
Thank you.
Bob?
Oh, hey, Francis. Nice to meet you. I have two questions. So one is, you said many hedge funds have failed with insurance companies. And I know Monish Pabrai set out to clone Buffett, and he was pretty incentivized to learn and master this. And he seems like a pretty smart guy. But I think I heard on a podcast that even he felt like it was outside of his circle of competence. So that's one of the reasons he sold it to you. And I was curious, how did you develop your circle of confidence in insurance to feel confident that you have an edge here?
Well, I've been with Fairfax since 1985. And so Fairfax went through, has done really well. We went in at $3, and right now, the book value, we put in money around $3.25. So as of now, it's around over $500. So it's done really well. But in spite of doing so well, it went through a lot of turmoils, a lot of troubles. So when you have troubles, and like I was always involved in these troubles, I always want to be part of it. You learn from, some frustration, some failures, and that's how you hone your skill. You cannot be good at anything without going through, working through failures. So I was really fortunate to be involved in a lot of troubled circumstances, and that gave me the confidence of, that if I buy into Stone Trust, how to handle some of them.
How was
part of it is dealing with the regulatory authorities. There are a lot of restrictions, what you can do, and so on and so forth. But you just live with those regulations.
Okay. And then my second question was, when you value a company now, how much time do you spend on the math side of the valuation, and how has that evolved over time since when you first started investing?
I think when I first started investing, I was more concerned. I was, my background was such that I needed some comfort factor. What am I getting? Is it solid at 100 cents? So net provided that kind of comfort security. And if I buy it at 60 cents and I do it over and over again, provided there were lots of them, I would do quite well. It's kind of a formula. And in 1980, there were plenty of them, 500 nets. Nowadays, you'll be lucky just to find one. And out of those 500 nets, there were a lot of high quality companies that you would do really well. But in time, those type of net companies just disappeared. And so, but I was fortunate that my business experience was also expanding. And then I was able to buy into companies that was not nets and still buy them cheap enough. So my career span like 40 years. So you'll be if you're that long, you'll go through some troubled times. But the thing is that you cannot get yourself like ruined or destroyed. You can bend. Sometimes it may not do well. Like we haven't done well last 5 years or so. But value investing, if done properly, you should always bounce back. So that's the key to it.
So how did your upbringing, I guess, prepare you to be a value investor?
To prepare me, it's just kind of, you understand this, if you go back historically, a long time ago, through some of the greatest value investors, and the guys who have run really well, like John Templeton and so many other ones, your batting ratio has to be around at least 60% to do well. If it is below that, then you won't succeed. So if you buy 10 stocks, you can expect 6 to do well, and the other, other 4 companies most probably will be mediocre, and some of them will be, may not do as well, may even go negative. But if you're consistent with it and your valuation is fairly accurate, you should do quite well. It's just like baseball. If your batting ratio is 300, it's outstanding. It doesn't have to be 100%. But when you first start investing, you think, if you buy 10 stocks, all 10 stocks have to do well. That is not the case. As long as you're 60 to 70% successful and you don't take a big hit on the other 30 to 40%, you should do quite well. So there's a certain batting ratio where if you can be at that level, then you should do okay long term. So early on, you may get frustrated if you're not 100%, but that's not the way life goes or investing goes.
Aravind?
Hi, Francis. It's great to see you. I have a question regarding the postmodern internet companies, these asset-light companies. I've always been curious as an academic looking at how to view these companies. For example, a company called Zomato came for an IPO in India. These aggregators and companies which live on the internet with very minimal assets and get valued for billions of dollars. What is your take as a value investor on this? These companies which keep burning investors' cash and don't turn positive operating cash flow. What do you think about it? What's your intuition?
Yeah, so you're coming into an area where, it's called, you're coming into an area called circle of competence. So what happens in the stock market is that there may be, let's say, 40, 50,000 companies. Out of that, you just need to know around 100 to 200 to do well. So it's something like if you're a sports athlete, right? And so sports athlete, you can do really well if you pick, let's say, tennis. You don't need to go into basketball. You don't need to go into football or baseball or soccer and so on. You would do really well if you stick to your circle of competence. So in this area that you're talking about, most probably I will not have enough information or enough experience and knowledge to be in it. So most probably I will pass on it.
Thank you.
So if I pass on it, that doesn't mean you're an idiot or something like that. You don't know anything about it. It's just that what I mean is that it's just that it's that there are other areas where I have greater experience, greater knowledge, and I would have greater conviction on handicapping, my success ratio. So that is what you're going to do is handicap in these ones. Like I know more of this than most other people, and therefore I should be more successful.
Chris.
Hi, Francis. Thank you very much for your time. I'd be curious, just to follow up on something you said about the last 5 years being difficult and today's overvalued market. I just wondered, are you keeping your powder dry at the moment and just analyzing your options, or do you need to invest, or are you investing actively as well and finding, the value companies?
Yeah, so in the Stone Trust, we are much more, we have a $200 million portfolio. Right now, I'm sitting around 65, 70 million cash. Just like a dry powder. And we were really fortunate last, a year and a half ago before COVID hit, Stone Trust had about $35, $40 million in cash also, sitting there doing nothing, earning zero returns. And so when COVID hit, the stocks went down and the bond portfolio went down. That's when we really went into it. It's easier said, and now you can look back with, looking back on it and say, oh, I did all the right stuff. But it needed guts to buy them. When COVID hit and the stocks were tanking and the bonds went down from 100 cents to 60 cents on the dollar. But that's when we went in and bought a lot of it. And you can see in my reports, I don't know if you saw my reports, and you can see we have done really well in the bond side and also equity side. But last year provided a great opportunity to go in. But you don't want something like that to happen, a human event that affects so many people, where you go then make money on it. So right now we're just waiting our time. We have 65, 70 million in cash, either in the bond side or equity side.
Javier?
Thank you, George. Thank you, Mr. Chou. I have 3 questions for you, Mr. Chou. The first one is, do you make mistakes, or have you ever made mistakes, or does your team make mistakes, and how you handle them?
Oh yeah, sure. But I've made plenty of mistakes, and without making mistakes, you don't learn from it. And so that's one of the good things about making mistakes. So I made up mistakes all over the place. Some of them are psychological. Some of them, being boneheaded about it.
And
so that.
Do you beat yourself, or do you beat your team when they made mistakes, or do you fire them when they made mistakes?
No, I make mistakes, and I have a normal way of, and a really corrective way to correct my mistakes. So if I make a mistake, I just rebate my fees. I just take a punishment, monetary punishment. So in my bond fund, we didn't do well until 2019. We did badly. So I returned 4 years of fee, which is about $1.5 million. So that's one way of beating yourself up.
And the second question is in the same vein. And how did you learn to manage your own emotions and your team's emotion? Because now you're a big company and you're surrounded with a lot of people and their emotions when it comes to investing. Did you find a rule or a way to handle your own emotions?
Yeah, but what you're asking is a question that is not talked about but highly important. Success in investment is not so much like based on high IQ and so on. You can see if you go to Bay Street, most of them are in the top 2%, but hardly anyone on Bay Street or Wall Street really make a lot of money on investment, just investment alone, other than they'll make money on fees and commissions. But how to handle your emotions, or how you handle mistakes, how you handle setbacks is the key to being successful. So you have to be impassive. You have to be rational in spite of what is going on. So you cannot be too excited when you're doing really well, and you cannot be way too depressed when you're doing badly. And there's a way to get around it is just look at the mistakes you have made, look rationally where you went wrong, whether it was psychological or whether it was a valuation mistake, and then correct it going forward.
And my last question is this one. Is it important to be focused or to have focus in business or in life? I do this question because of this. I have been reading your reports, and you invest in a lot of countries: China, South Korea, India, Singapore, Japan, Marshall Islands, Malaysia, and in too many countries. So is it important to have focus, or how do you handle that? The thing that now you're a big company and you invest everywhere.
Yeah. So what happens is that you're looking up, when you're looking at companies, they give you certain markers, certain characteristics, and that's what you're looking for. And these are the type of markers that you need that would make you that would make the company successful. And so that's what I'm looking at. And by and large, that has worked out really well. One area that if you go into companies like China, India, and third world countries, is not to go into what you call trouble companies. Trouble companies, as you know, in those countries, there's enforcement is not there. They don't have the same controls or same securities legislation. So when they do badly, they tend to hide things, and they can take things away from you. I remember we invested in one Chinese company, had $5 per share in cash, and I thought, has no debt, and I was buying at $2. And so a few years later, the CEO just took that money, $5 per share for himself. And then it just disappeared. And so we got one guy that knew the CEO, and he tracked him down this guy is from the United States. He went to China and tracked that guy down, tracked the CEO down. And the CEO said, okay, you found me. Now what are you going to do about it? That's it. There's not much you can do about it. So that's the danger with third world countries, something in China. They can just take the money, and they have 2 or 3 sets of your financial statements, and they can give you either one of them or the third one. So just to be cautious, there's certain rules in third world countries that if you get cheated, you cannot get back your money. Unlike in let's say United States, Canada, or the more advanced European countries.
Thank you, Mr. Chou.
Oh, you're welcome.
Anna.
Thank you. Thank you, George. Good morning, Mr. Chou. So if you are going to speak to a class of 15-year-olds who would like to be value investors, what would be the characteristics that you would share with them to become a successful ones? And I'm asking this question because I have a 15-year-old, but I also consider that I and probably some of us are in the same boat where we are beginning our value investing career. What are the characteristics to build upon?
Oh, so the characteristic is basically like a bargain, bargain shopping. So by nature, let's say if you always buy stuff, let's say your daily goods, food and other stuff that you buy, merchandise that you buy, and you like to buy it at a 30% discount or 40% discount, you already have that trait to be a good value investor. You just have to apply it from that side to the stock market. So you're always looking for a discount, looking for a sale. And if you do that all the time, or most of the time, that trait is born in you. And so it's a transition. To make the transition from what you do personally to the stock side is sometimes difficult because there is some kind of a feeling or some kind of understanding that you need to make a big jump to go into investment. But it's at the end of the day, it's the same thing. You're just buying stuff at a discount. Now to do that, what you have to do is get yourself educated on the accounting side, of how these stuff are accounted for, accounting and so on and so forth, and that's the key. Otherwise, it's the same thing, just shopping, your normal shopping. And that's what I did, by the way. I was a fairly good shopper when I was young, and I did shopping for my family and all that. And I just transferred that temperament, that skill, onto the stock market, and it worked out really well.
Thank you,
Justin.
Hi, Mr. Chou. Thank you for your time today. I was just kind of curious when you wound up returning those fees when the market wasn't doing so well. Number one, what was your investors' reaction? Were they pretty blown away overall? And number two, I work in real estate out in the Okanagan, and we offer a 3% commission, whereas the older school model was higher. And so, did you ever have any of your fellow hedge fund managers, hey, what are you doing? Returning fees, you're making me look bad. Did you have any other blowback amongst your peers in the industry?
I think when you return fees, sometimes the other managers may not like it because sometimes you're like kind of setting a precedent. But no one has done that, like rebating it. They may waive it going forward, let's say for 6 months or so on. Mm-hmm. But when you rebate it, people in the industry sometimes may frown upon it because you're setting a kind of an example, and they think their own investors may ask them to do the same. But I've always done it. I just did it. If you give me the money, I'll try and treat you, as fairly as possible. So that's the way I go. I just do it more out of self-satisfaction.
Gotcha. Thank you so much.
Camille.
Good morning, Mr. Chou. Thank you for being with us. I have a couple of questions. The first one is, could you walk us through your investment process? So how do you look for the potentially good bargains? How do you assess the business? How do you analyze the business? How do you assess the risk? How do you value the company? And when do you get confident enough to buy it?
Yeah, so if you go back 40 years, I was just doing nets. So basically, you do it by numbers, and then you look at a few things. A few other things is, does it have a lot of debt? Does it have a lot of pension liabilities, and so on and so forth? So that was really a cut and dried way of doing it, and it was really simple. But those type of opportunities disappeared. But now it's different. But now you look at the last 10-year history, 10 to 20-year history, like how has the company done? How has management, how has management deployed the earning power? Let's say a company make money, right? Then they have the earnings there and the cash there. How did management deploy it? Where did it go? And what were the returns? And so now it's more qualitative, and it makes it easier for me to analyze those, because that is what I'm doing now. When you're running Stone Trust, and Stone Trust is making all this money, the investment has grown, and then you're thinking of where to deploy it. Do you want to go into new venture? Are there returns there? And so qualitatively, you're looking at more or less what management is doing. And then you're looking at the industry side, like how far more can it grow? Like, is this industry in a growth area? It's different, like something like Coke versus Facebook or Facebook or Google, which is growing more rapidly. So how it's growing also factors into your valuation. And so you can see, and so you need to be really right on these areas. So if you're buying into good companies, you're buying into a kind of future earning power, and that sometimes is really hard to analyze. Now you don't analyze, whether to invest into something just because the stock has gone up from $100 to $150, and therefore you want to get into it. You go and invest, say $100 went to $150, provided the intrinsic value the last 3 years has also gone from $100 to $150, and that is okay. But you never go based on what other people are doing, based on rising prices without reference to the valuation of the company. But deep down, the basic thing is valuation. You just buy them cheap. And if you're correct on that valuation now, and if you're correct 5 years, what is going to be worth 5 years from now or 10 years from now, you will do really well. If you do badly, it's because those valuation didn't pan out the way you thought it should have panned out.
Okay, thank you. Another question that I have is regarding how much capital do you keep as cash, and what is your thinking regarding it? So what are the drivers? So for example, if we are in a current market situation when everything seems to be bubbly, does it impact the way how much capital do you have in cash? How do you think about it, and how do you assess it?
Yeah, in the past, in my mutual fund, I've always, in these type of valuation, I've always kept 20 to 30% cash, and kind of stayed with it. I know Benjamin Graham also favored 60-40 ratio, more or less. That has worked out. 60% equities, and 40% of fixed income. And you can go with something like that, but it's better to have some cash. But more or less, stocks have done really well. If you go back to 1929, the Great Depression, the market went down from 290, 300 down to 70. But if you notice, if you just stayed there, it would have done really well. From 300, from 1929, and right now the Dow is over 35,000. So do not do not forget to take into account how strong a free enterprise system is. The intrinsic value is always rising over time, and so don't underestimate the power of capitalism. As long as it doesn't go to socialist, you should do quite well if you just stay in equities.
Okay, thank you very much.
Christoph?
I have a more general question. What keeps you actually most awake when you look at the market and at your portfolio?
But you're looking for something where what could happen to the companies I've invested in, like where it would crush it. So you can see what happened. COVID hit, and I was in a lot of airlines, and that really pummeled it. And luckily, it wasn't a big portfolio. Like in Stone Trust, we had some airlines, and they looked really cheap. But COVID hit, and really it disrupted their economy. Now the same thing happened in a 9/11 situation. It took like 6 years for the airlines to come back to what it was previously to 9/11. So you lose that earning power for a while. Also in the restaurant business, where it could just pummel you. So you're looking for something that if something happened to your portfolio, you don't want like 100% to be ruined. Like 10 or 20% if it happened, then that is fine. So your question is more on the whole portfolio rather than just one industry. So if you're, as long as I've been in the market, there will always be something like 5 years. Every 5 years, there'll be something that will hit you from left field, something that you just cannot prepare for it.
Okay, good stuff. Orid?
I got a few questions. Are you a bit more of a fan of cyclical stocks or more defensive stocks? Because I'm pretty sure if you believe that a downturn is going to come, a lot of people say you should buy defensive companies. And if they say during bull markets, like right now, I feel like right now it's a confusing time with COVID and everything, but we're getting out of COVID, I believe, and so it makes sense right now to buy cyclical companies, but there's a lot of uncertainty. So I'm just curious on what are you currently buying? Are you buying more cyclicals? Or are you trying to keep it a bit balanced between the two of them?
There are pros and cons. If you buy into cyclicals, for example, like I had Resolute Forest Products for a long time. I bought it around $10 or so, long time ago. And last year went down to $1. $1 means the whole company was selling for $80 million. Yesterday, you know how much money they made in one quarter? Like $300 million. Like it's selling for less than one times 1 quarter earnings. So that is the danger with cyclical. It depends so much on the pricing power of that commodity. And so what happens in this when you buy cyclical, and I've been involved in a few of them, you really have to buy them when the cost of that product is when the price of that product is below the cost of production. That's the safest way to play. So there are pros and cons. So here, if the cyclical is really hasn't gone up, then most probably I may go into it. And so again, it is based on long-term valuation of that company, and you always have to go down to valuing it.
And then I have another one. Do you what kind of ratios do you usually look at? Do you look at the operating margin? I feel like that's one margin that I was that I'm a big fan of now, because I didn't know what it was before, but I'm a big fan of free cash flow. One of my favorites is probably the dividend payout ratio, just making sure they can keep their payouts, because I was looking at Stella Jones recently, and I think they have a 17% payout ratio, and I have another insurance company that I bought a while back where they had a 20% payout ratio. So there's plenty of room for margins of error. I'm just wondering what your thoughts are about those simplified ratios.
Yeah, that has worked out really well, those ratios that you're talking about. The company consistently can pay dividends, and paying it out of, let's say, 20% of earnings, then most likely you have a good company, and you can buy them, and it will do quite well if you don't overpay for it. So those are, I know Benjamin Graham also looked for a lot of companies that were paying, solid dividends. We used to have something called 6%, the 6% ratio, like 6 times PE, 6 times dividend yield, and so on. So that has worked out if you have that formula, if you can find enough of them. And as long as they're good company generating cash, and those dividends coming out of cash, but not out of selling assets or raising money in the market. So by and large, that will work out quite well.
Okay, thank you very much.
Jill.
Hi, thanks, Mr. Chou. I just have a couple of quick questions. If you identify a really high quality company, are you more lenient on the margin of safety? And my second question is, have you ever looked at Switzerland, and why do you think there's so many high quality companies that have been there for so long with such high market caps when it's really such a small country? And if you compare it to other countries like Canada, we don't have anything like Nestle or Lindt or some of those major brands that seem to last for decades.
I don't know. Switzerland, I've heard, is fairly embraces capitalism, and they have done quite well over the years. And the companies have done really well too, and those are some of the great companies that you mentioned. Canada is resource based, so it's a different type of economy, but Canada by itself has also done well. So it's really hard to say, country to country, but by and large, the freer the country, the freer it allows businessmen to run its own operation, the better it would be for the economy.
And just going back to the first question about when you identify a really, really high quality company with high earning power, are you more lenient on the margin of safety for your entry price?
Yeah, so the margin of safety. So you're looking at margin of safety. Something is instead of being a price being based on price, the margin of safety comes in the quality of the company. And so when you're looking at securities, there are different ways of what you call margin of safety. One is quality of company, quality of management, quality of that industry that they're in. So that should be factored in too. And so if it is there and you're paying up, and if you look back on it, most likely that if you're buying better quality companies, you're not overpaying for it, more or less, as compared to something that has static value, like it's not growing. If you do the math, you can just see, like the earlier example I gave you, if it is worth $100 and 10 years it's still worth 100, like how much it is really worth paying for it. But if something is worth 100 and 10 years from now, growing at 15% is worth 400. How much you can definitely pay up 80 cents on a dollar versus trying to buy it at 60 cents on a dollar. Even if you pay it up 80 cents on a dollar, will work out quite well, provided it can grow at whatever the rate that you think it's going to grow. So you need those qualitative factors, other factors there, that becomes a part of your equation, part of your calculation.
Suraj?
Hi, Francis. Thank you for being with us today. I have a few questions. My first question is, how often do you look at your own portfolio?
I tend to be long term. So I look at it, when I see the quarterly earnings coming out, and I see, every quarter how the company is doing, and then, but basically I keep them. Once I buy it, I keep them more or less longer term. And I keep them like 5 to 10 years. And sometimes when you have that type of personality like I have, is to not to sell them after you buy them. It's better to go with higher quality companies. If I'm going with nets, then you need to sell them every 2 years or so. And so then that comes in with a different type of personality.
Okay. My second question would be, how once you have identified a stock which you think is a good company, but the price is more than the intrinsic value, how do you track that company? Is it on a daily basis or a weekly basis, or how often do you check whether it's
No, so I try to track it every quarter to every 6 months, more or less follow the company, even if I don't buy them. So a lot of companies I followed like 20, 30 years, and just followed it. Yeah, and when you're in the market, you're not. The thing is, a lot of people, I think they make a mistake. They only are interested in a company provided they think of buying them in the near future. A lot of times we are just studying them, reading them, assimilating knowledge of different companies. Even if I'm not buying them, at some point in the future, something will happen and you may need to buy them, but then you don't need to do a lot of work on it because you have followed it for so many years. But by and large, it is a mistake just to look at a company just because you're going to buy them now. It's just a general knowledge, and you keep up the general knowledge for a lot of companies.
Correct. Thank you, sir. One more question. When you buy a company and the value of that company crosses the market value, and you feel you want to sell it, so do you have multiple sells and entry into the same stock? Do you end up selling and buying the same company multiple times based on the price?
Yeah, basically, if it hits closer to intrinsic value, you're thinking of selling it out because you're looking at substitute. Is there something else at a better price with similar quality? If you don't find it, more or less, I may just keep it. But by and large, you should try and sell them.
My last question.
What happens is once it hits intrinsic value, you're going to say that more or less the company the returns would be around 6 or 7% a year.
My last question is, what do you read to keep yourself fresh, and also what do you recommend for us to read in accounting and principles?
Yeah, that's a really good question. So basically, like what I do is I read the Wall Street Journal and all the major magazines more or less on my computer. Several years ago, it would be like hard copy and just follow it. And a lot of stuff at this time, at your stage is also to understand and read a few psychology books. And when you're reading books on psychology, it's more to understand yourself rather than other people. Like, how do you react to different events? How do you react to bad times? How do you react to failures? And how do you react to other people gloating? The stock has gone up 200% where yours has not gone down. And it's more a reaction of yourself. And if you react and you have no reaction to what other people are doing, you have a foundation to be a good investor.
Thank you.
Pawan?
A couple of follow-up questions. How do you think about position sizing? If I look across your portfolio tends to come across pretty concentrated. And how much time do you spend on these positions, building them up? So is it like from 0 to 10 on kind of day one, or is it over a period of time that you want to see management, how do they kind of perform?
Yeah, so this question, I think, more or less falls rather than based on numbers or based on percentages, based on human psychology. I'm a concentrator, but there are a lot of other investors, let's say Peter Cundall or Benjamin Graham, they have been successful buying a bunch of stocks. So they buy it based on a book, a book of companies, let's say as a totality, right? And so they like to buy like 20 nets to do well, or Peter Kernel will buy 20 nets or 20 of those discount to book value. I am more of a concentrator, so I would try to understand something really well and try to buy more of it. So I would start with myself, let's say a 3% portfolio, but I'm more or less more towards a concentrator. And I'm more like a rifle shooting guy rather than someone else using a shotgun approach. And so this is based on a different personality on who you are, like as a person. So if you're a concentrator, then you start with, I would say, 3%. Otherwise, if you are someone who likes to buy like the whole book of companies, then you can go with 1% of the companies. So you have to identify yourself. Are you more comfortable having 30 stocks in your portfolio, or are you more comfortable buying, let's say, having 10 stocks in your portfolio? I know Charlie Munger was most comfortable just having 3 stocks in his portfolio.
And in terms of being an investor, do you also, in your history, have been involved in kind of an activist position for companies?
Activist is really hard. I've tried not to do that. Simply, I would sell it and move on to another company. There's like over 100,000 companies now, and why fight on a little piece? It takes a lot of time and energy, and unless you're a lawyer in that side, it's extremely expensive. Have you ever seen how much the lawyers charge you for a little bit of work they do? Like it's $1,000 an hour.
Okay, thank you.
George, I've got a quick question, Francis. So if you want to be a successful individual investor, do you think it's important to go work as an analyst for some period of time, and are you at a significant disadvantage by not doing so?
Yeah, I think you have a really good question. I would say if you want to work for someone, work in a value firm, because there's a certain, if you're new, certain type of characteristic gets ingrained based on the company you're working for. And so that is what I've noticed. So if you go to a good value firm, that is better. But if you cannot find a value firm, it's better to work by yourself. Like I'd never work for an institution, for anyone. I was having my happy time at Bell Canada working as a technician, and that's where I learned my investment on my own. But I would have progressed if I worked for another value firm. But I would have been destroyed, hurt badly in my professional career if I worked for someone else that were not truly value oriented. It would have been better, the way I went, I learned by myself. And that was a huge plus.
Justin?
Oh, yes, thank you. Yes, just to kind of a follow-up to the book question, anything outside of Ben Graham and Warren Buffett, is there one book in particular that's impacted your life or your investments, your investing style?
I think a long time ago, I read a few books on psychology, and then I realized your human temperament, human psychology plays a really big role on how to be a successful investor. All these books, Benjamin Graham and all the stuff is fine, but you will find in the Bay Street and Wall Street, most people, 99% of the people that go into the investment have a hard time applying that psychologically. They just cannot do it.
Gotcha. Is there any particular psychology book that you would recommend, or?
The Kahneman book is really good.
Kahneman, okay.
Yeah, and if you go through it, and a few other ones that ask you to self-analyze yourself, how you react to certain stimuli. Those are really good books.
Okay, wonderful. Thank you.
Should I? We have 5 more minutes. Okay, so.
Okay, I'll keep this short. So. Mr. Chou, my question is, as your team is growing, as new analysts come to your team, what kind of, not training structure, but like what kind of readings do you recommend to them? Are there certain investor letters? Like, how do you ramp them up in the first 6 months or a year to kind of, be more fluent and, assist you and support you better?
Yeah, so I would ask them to read all the Buffett letters that is compiled. He gives you a lot of good insights. And then after you read that, then 3 months later, I would ask them to reread it again as your knowledge increases, and then reread it after a year. Because every time you read it, you'll find something that you missed because the experience that you have or the knowledge you have, you were not able to grasp that wisdom. So I would just reread them every 3 to 6 months, and then every 1 year, 2 years later. And so by the time you know it, you have read it like 10 times. Like for example, Warren Buffett, when he was testifying, in front of the Senate and the Congress. No, he would give you, he would quote, all the what Benjamin Graham said in his security analysis right onto that paragraph and to that page. So he read it more than 20 times, and he would even give you the different edition. Because each time you grow in knowledge, you read it, you get something different. You appreciate more of the wisdom. So,
thank you.
A friend of mine, Peter Kaufman, does something really different. Whenever he reads a book, he photocopies every page and puts it in a binder. That binder is just one page by itself in a plastic, cover. It's separated. Each page is separated and highlighted big time. And then he reads it, rereads it, every 6 months. You should really see how he does it. Well, one year I asked Peter, can you send me that binder of yours, on that book that you really like? So he sent it to me. Then I got an idea what he was talking about. I thought he was just joking, that every page is photographed and he puts it in a plastic cover. And that page is reread every year, all those pages. Now, as you know, he was really serious, and you could see at a really young age that he was most likely be highly successful. So you know what he used to do when he was in university? Just after dinner, he would go 2 hours. That is his routine, 2 hours to the library and read everything that is not part of the curriculum. And just imagine if you add up 2 hours over 365 days for 1 year and do it over 4 years. That's a lot of hours he spent on something that in terms of gaining wisdom. And no wonder he came out highly successful.
Thank you very much. That was really insightful.
We'll have a last question, I guess, by Christoph.
Just different question. What about investing in family-owned companies versus companies controlled by external management? Like, do you have a preference, and what are your considerations for it?
Yeah, so that's a really good question. I prefer companies that are managed by family-owned because they have a vested self-interest and they run it really well. If it does badly, they themselves will get badly hurt. So they have an incentive to do well, and you can see family-owned businesses have done really well. And with external managers, sometimes interest is not the same type of vested interest is not there. Although some managers have done extremely well, they think like owners. And sometimes when you have external managers, their stimuli or their incentive is very different. They want a bigger office, more number of people, more employees, and that's where the self-esteem comes in. And so you need to be careful with that. Family-owned business, if they do it, they just lose more money and their net worth goes down. So,
okay. Yeah, last question from Camille. Camille had his hand for some time. Camille, ask the last question. Okay, we're done.
Thank you very much. Mr. Chou, so I have another question. So assuming you are investing your own capital for a couple of years, you have a nice track record for, let's say, a decade, and you want to start investing other people's money, how would you try to raise the capital? Or what would be your first step, and how would you tackle that?
So you can do what I did. It kind of looked stupid at that time, but so with me, I was just happy whether I had $10,000 of money to invest, or 1 million, or 10 million, or 100 million. So it was it was indifferent to me. So I started with a bunch of Bell Canada guys. I was working there, so I had my fellow technician. I said, "Can you give me some of your money? I know how to invest." And so they gave me $51,000. We started with $51,000. It was called Chou Associates Fund, and that was my history. Like, it was only 51,000, wasn't 10 million, wasn't 100 million. So once you have that money, you just want to show to the world that I know how to invest. You want to demonstrate. It's like yesterday was the NBA draft. Just have to show up and show what you can do on the court. Go for trial workout, and it doesn't matter where you're coming from, China, or France, or Cameroon, or anywhere. If you're good enough, to compete, people will notice, and you'll get accepted. So that's what I did. I competed with $51,000. After 3-4 years, I showed I could. I know how to invest. I went to Bay Street, and everyone, started opening the doors. They stopped asking me all that question. Do you have a university degree? Have you worked for an institution? Do you have Canadian experience? All that thing stopped once they saw the record. So that is what free enterprise system is. So just go on merit, show to the people, even with a small sum of money, that you know how to invest. And off I went. So that was what I was waiting for or hoping for, and it worked out. And that is what a free enterprise system does. I would not have succeeded like that. Let's say in a closed world like a communist world, communist China, and a few other third world countries where you need connections, you need network, and all that stuff.
Okay, I think we're running out of time. Francis, what's the most important thing in life and investing that you learned over the last 40 years?
Yeah, but I think first thing is whatever you do it honorably, honestly, and then examining yourself, understand your own psychology, and then there's a bunch of traits that comes in that makes you successful. So you have seen how I did it, and it was kind of difficult initially, but I followed that path and has worked out quite well.
And thanks everybody, guys. A big round of applause, I guess. Applause to everybody.
Thank you.
Thank you, Professor George.
Thank you.